Industrial REITs and data center REITs are two of the most important real estate stories in 2026. One side owns the infrastructure behind the physical economy: warehouses, distribution centers, logistics facilities, supply chains. The other side owns the infrastructure behind the digital economy: data centers, cloud infrastructure, AI workloads, compute capacity. So the question is simple: where is smart money going? Industrial REITs move goods, data center REITs move data. Both can be essential, both can benefit from long-term demand, and both can attract serious institutional capital. But the risks are not the same. Industrial REITs can be cyclical. Data center REITs can be capital-intensive. Industrial REITs depend on logistics demand. Data center REITs depend on power, cloud, AI, and massive investment. So in this video, we're going to compare both sectors like investors, not like hype chasers, because both are infrastructure, but the risks are not the same. Let's start with the physical side of the economy: industrial REITs. Industrial REITs own real estate that helps goods move through the economy. That includes warehouses, distribution centers, logistics facilities, supply chain properties, and last-mile locations. The easiest way to think about them is this: every product that gets manufactured, stored, shipped, delivered, returned, or restocked needs physical space somewhere. That is where industrial REITs come in. The most important example is Prologis, ticker PLD. Prologis is one of the largest logistics real estate companies in the world. Its properties are tied to supply chains, e-commerce, inventory management, global logistics, and the need for companies to place inventory closer to customers. The bull case is not just online shopping. It is the idea that modern supply chains need better locations, more resilience, and more efficient distribution networks. Industrial REITs own the real estate behind how goods move. But the digital economy has created another kind of infrastructure landlord. That brings us to data center REITs. Data center REITs own the real estate behind how data moves. These companies own data centers, co-location facilities, hyperscale campuses, cloud infrastructure, AI workload capacity, and interconnection assets. The main examples are Equinix, ticker EQIX, and Digital Realty, ticker DLR. These businesses are tied to a different kind of demand: not packages moving through warehouses, but data moving through networks. Cloud migration, artificial intelligence, enterprise digital transformation, low latency computing, and massive growth in compute needs. A data center is not just a building. It needs power, cooling, connectivity, security, scale, and location. That makes data center REITs very different from traditional real estate. They are still landlords, but they are landlords for the digital economy. Data center REITs own the real estate behind how data moves, and that is why comparing them with industrial REITs matters so much in 2026. This comparison matters because both sectors are infrastructure-like. Industrial REITs and data center REITs are not just ordinary buildings with tenants. They are tied to bottlenecks. Industrial REITs are tied to physical bottlenecks. Where do goods get stored? Where do companies place inventory? Where can products move quickly to customers? Data center REITs are tied to digital bottlenecks. Where is compute capacity available? Where is power available? Where can cloud, AI, and enterprise data actually operate? That is why the market is interested in both sectors. Both have structural demand. Both require heavy capital. Both can benefit from scarcity. And both can have pricing power when supply is limited and demand is real. But the economics are different. Industrial REITs may offer steadier real estate demand. Data center REITs may offer faster digital infrastructure growth. The market is not just buying real estate, it is buying bottlenecks. Now let's look at the industrial REIT case through Prologis. The main industrial REIT case study is Prologis. Prologis is best known for logistics real estate, but in 2026, the story is becoming broader. In the first quarter of 2026, Prologis reported core FFO per share of $1.50. The company also reported record lease signings of 64 million square feet, And importantly, Prologis reported $1.3 billion of build-to-suit data center development starts. That is the part many investors should notice. Prologis is no longer just a warehouse story. It is becoming an infrastructure platform. The core business is still industrial logistics, warehouses, distribution, supply chains, customer demand. But the company is also showing how industrial land, power access, and development capability can connect to the data center opportunity. That makes Prologis interesting because it sits near the intersection of physical infrastructure and digital infrastructure. The bull case is scale, essential logistics, resilient customer demand, capital access, and the ability to grow into infrastructure opportunities. Prologis is no longer just a warehouse story. It is becoming an infrastructure platform. But the industrial bull case is bigger than one company. The bull case for industrial REITs starts with a simple point. Even a digital economy still needs physical logistics. E-commerce still needs warehouses. Retail still needs distribution. Manufacturers still need supply chain space. Companies still need inventory management. And customers still expect faster delivery. Well-located industrial real estate can be valuable because location matters. A warehouse near a major population center, port, highway, or logistics hub can be difficult to replace. That scarcity can support occupancy, leasing demand, and pricing power in strong markets. Reshoring and supply chain resilience can also support demand if companies want more control over inventory and production networks. The key advantage is that logistics is not optional. Goods have to move, and the real estate that supports that movement can be essential. Industrial REITs can benefit from scale, tenant relationships, location, and operating expertise. Even a digital economy still needs physical logistics. But high quality does not mean risk-free, so we need to look at the industrial risks. Industrial REITs can be high quality and still cyclical. That is the key risk. If the economy slows, leasing can weaken. If companies reduce inventory, demand for warehouse space can soften. If developers build too much in certain markets, oversupply can pressure rents. Rent spreads can slow. Cap rates can move higher. Development costs can rise, and higher interest rates can pressure valuations. This is why investors should not assume that logistics grows in a straight line. Even great property types have cycles. The question is whether the REIT has the balance sheet, locations, tenants, and scale to survive those cycles. Industrial REITs can be high quality and still cyclical. Now let's turn to the other side of the comparison, data center REITs. For data center REITs, the two major examples are Equinix and Digital Realty. Equinix is one of the leading digital infrastructure REITs. For 2026, Equinix guided for total revenue of $10.144 billion to $10.244 billion. It also guided for AFFO per share of $42.31 to $43.11, and expected total capital expenditures of approximately $4.1 billion. That last number matters. Data center growth requires huge capital. Digital Realty also shows the demand side of the story. In the first quarter of 2026, Digital Realty reported a backlog of signed but not commenced leases of $1.8 billion of annualized GAAP-based rent at 100% share. At Digital Realty's share, that backlog was $1.0 billion, and the weighted average lease lag was 19 months. That means demand is visible, but revenue recognition can take time. Data center REITs are selling scarce capacity into a market hungry for compute. But the big question is whether that demand turns into attractive returns after all the capital required. The bull case for data center REITs is one of the strongest real estate narratives in the market. AI needs compute. Cloud needs infrastructure. Enterprises need data capacity. Digital transformation needs reliable networks. And low-latency computing needs strategic locations. That creates demand for data centers. But the real bull case is not just demand. It is demand meeting constrained supply. Data centers need power. They need land. They need cooling. They need connectivity. They need permits. They need capital. And in many markets, the hardest constraint is power availability.
When capacity is scarce and demand is urgent, the landlord can have pricing power. Pre-leased capacity and large backlogs can make the growth more visible. That is why investors are paying attention. Data center REITs are not just writing an AI headline. The best ones are selling mission-critical capacity into a constrained market. When capacity is scarce and demand is urgent, the landlord can have pricing power. But growth like this is not free.
The biggest risk with data center REITs is that growth is capital intensive. AI demand is powerful, but data center growth is not free. These companies need massive capital expenditures. They need power, they need equipment, they need development capacity, they need financing, and they need customers to sign contracts that generate attractive returns. Power availability can limit supply. Hyperscaler bargaining power can pressure economics. Technology can change quickly. Valuations can become expensive. And if hyperscalers slow their own capital spending, the market can quickly rethink the growth story. That is why investors need to separate real demand from overexcitement. A data center REIT can benefit from AI and still be a bad investment if the price already assumes perfection. The key question is not just whether AI demand is growing. The key question is whether data center owners can turn that demand into high-return capital deployment. AI demand is powerful, but data center growth is not free. And before we compare both sectors directly, this is a good place for a quick pause. This is the kind of REIT analysis we focus on at Boring Money Wins. Not just chasing the hottest sector, not just assuming every warehouse REIT is safe, not just assuming every data center REIT is an AI winner. The goal is to separate real infrastructure from market excitement, to look at cash flow, risk, valuation, CapEx, demand, debt, and return on capital. If you like no-hype REIT analysis that looks beyond the headline, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want real estate investing without the noise. Now let's compare industrial REITs and data center REITs directly, the way an investor should. Industrial REITs and data center REITs can both be attractive, but for different reasons. Industrial REITs are tied to physical demand, logistics, e-commerce, supply chains, inventory, economic activity. Data center REITs are tied to digital demand, AI, cloud, interconnection, enterprise data, compute capacity. Industrial REITs may be steadier because the demand is tied to broad commerce and physical distribution. Data center REITs can grow faster because AI and cloud demand can create huge capacity needs. But data center REITs can also require heavier CapEx. Industrial REITs can be more exposed to economic cycles. Data center REITs can be more exposed to power availability, hyperscaler behavior, and valuation risk. So neither side is automatically better. It depends on growth, income stability, CapEx intensity, cyclicality, valuation risk, and supply constraints. Industrial REITs may be steadier. Data center REITs may be faster growing. Neither is automatically better. So where does smart money actually look? Smart money is not simply chasing labels. It is not buying something just because it says industrial, and it is not buying something just because it says AI data center. Smart money looks for economics, scarcity, structural demand, pricing power, strong balance sheets, access to capital, and attractive returns on investment. For industrial REITs, the attraction is essential logistics and prime locations. For data center REITs, the attraction is scarce capacity and AI or cloud-driven demand. But the label itself is not enough. A great sector can still produce poor returns if investors overpay. A fast-growing sector can still disappoint if CapEx destroys returns. And a stable sector can still struggle if leasing weakens or supply becomes excessive. Smart money is not chasing labels. It is chasing assets with durable demand and attractive returns on capital. That is the framework investors should use before choosing either side. If you were analyzing industrial REITs, ask a few basic questions. Is occupancy healthy? Is leasing still strong?
Are rent spreads still positive? Is there too much new supply in key markets? Are cap rates pressuring valuation? And can the REIT fund growth without damaging shareholder returns? If you are analyzing data center REITs, ask a different set of questions. Is demand turning into signed contracts? Is power actually available? Does the capex earn attractive returns? Does backlog become revenue? And is the valuation already pricing in perfection? Investors do not need to pick only one sector. They can use a REIT ETF. They can choose a sector leader. They can combine both industrial and data center exposure, or they can limit position size when valuation becomes too aggressive. The best REIT sector is not the one with the best story. It is the one where the numbers still work. Now let's bring everything together into the final verdict.
So industrial REITs versus data center REITs. Where is smart money going? The honest answer is that both sectors can make sense. Industrial REITs may win on stability, logistics, physical infrastructure, and essential warehouse demand. Data center REITs may win on growth, AI, cloud, digital scarcity, and compute infrastructure. But the winner depends on the price paid. Valuation matters, capex matters, debt matters, demand matters, and time horizon matters. The future needs warehouses, and the future needs data centers. The investor's job is not to blindly chase either story. The investor's job is to find durable demand, attractive returns on capital, and a valuation that still leaves room for mistakes. So smart money may not be choosing only physical or digital real estate. It may be choosing essential infrastructure where the economics still work. The future needs warehouses and data centers. The investor's job is to avoid overpaying for either one. And boring money usually wins, because boring money usually survives.